Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, January 5th, 2023. It is 10:14 Eastern Time. I'm starting the video, so getting this one out early, and it's going to be pretty much a completely redundant video. In other words, everything I'm going to say in this video, I said in the two posts I got out to you today, but I wanted to reiterate it because I feel like a big move's coming. When you have a trading range in any security, particularly one that's very tight, well defined, from those ranges usually comes powerful moves. And we've already had two whipsaws, and actually, if you want to count it today, like I say, I always talk about trading, waiting for buy and sell signals commensurate to the time frame you're trading off of. In other words, if you're trading on a weekly chart, all that matters is how that security or the index, whatever you're trading, closes at the end of the day on Friday at 4 p.m. That's when the weekly candles finalize. 60-minute chart as well. But with that being said, I know how the markets work, and I know there's traders that don't trade my way. They trade mechanically, and so when QQQ took that out today, and where I'm going is, again, I want to impress upon the importance or the potential, because the only thing more bullish than a pullback, a successful bounce off support like yesterday. I highlighted this as a got a post out to you, said that was an objective long entry, and if you were a day trader or even a swing trader, you made a quick 2% up to the top of the trading range. It's been a very well defined trading range. Holiday trading whipsaws are likely. You got one there, you got one there. Other than that, every single pullback or rally to the top of the range or pullback to the bottom range has produced a reaction. So, there was unarguably a fair amount of short selling that probably took place this morning because we took that level out. But I did my best to get that post off to you very quick and tell you that the broad market itself, the S&P 500, which is more representative of the entire stock market. You have a more diversification, more sectors included. The Qs are really mostly, it's a tech heavy index, doesn't have financials or things like that the S&P 500 does. So you can see we're still comfortably above, not by a wide margin, but still above the what I call the Christmas trading range, is really mid-December up to the through the end of the year, and that's where we're at. So and I always preach the benefits of watching multiple indexes, watching the futures as well, even if you're only trading one index or if you're only trading ETFs, or vice versa. If you're trading futures, watch the major index, especially during market hours. The futures are great. You can kind of see some breakouts pre-market and after hours, but really I put a higher emphasis on the actual indexes themselves during market trading hours, regular trading hours. Anyway, that's it. I just want to say that support is support until unless broken, and so far we have the S&P still above support. I got this chart out to you. There's both an uptrend line off the recent lows, which now has at least four distinct reactions on it, and then the trend line. So look, we can still break this. And it's almost looking that way now. Like I said this morning, I have a monitor full of tons of streaming charts, and what I saw this morning was unusual. After the better than expected employment report, which again, this market's a little schizo. It's, normally that'd be great news. The market would rally, economy, job market's strong. Consumer spending is 2/3 of GDP, and if the consumer has jobs, they have money, and blah, 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 blah. So from the backdrop, it's been an extremely resilient job market. And that's what the market's doing. That's why we have a trading range, by the way, guys. It's, people are trying to figure out, hey, okay, so this morning's report, why was that bearish for the stock market? Why did it go down? Well, because it says that gives the Fed additional fuel because that's their primary focus. They shifted away from high asset prices causing the inflation. And their biggest concern now is they are afraid we're going to start seeing wage inflation if the job market remains strong, and ultimately we will. So that means, with the strong jobs report today, good for the economy, yet bad for the stock market, at least perceived that way, because that would indicate that the Fed is going to continue to raise rates based on that. Okay, so at the end of the day, look, it makes your head spin. That's why, I like fundamental analysis. I incorporate it into my longer term outlook for the markets, my investing long term positions. But what's going to keep you on the right side of the trade here is trusting the charts. That's all we can do right now. And again, I'm doing this because again, this is a powerful range. It's been going on for about 3 weeks now, and just whether you all have, or most of you probably have your bias or your views where the market's going to go this year, where it's going to go this month. All I'm trying to say is respect this. If you are currently short and bearish, great. And if you are, and I'll be there with you if we break down. If I see all the indexes break down, right now the S&P and the small caps haven't, and the QQQ more importantly. Like I was saying earlier, there's IWM, by the way, still well within the trading range. Again, these are the charts I got out to you, so I'm being a bit redundant here. But this is what I say often, and this is where I started out the video. I kind of went off on a tangent. The only thing more bullish than a pullback to support with a successful, reversal or rally off that level is this: a break of that support level followed by recovery. Now, we didn't get again, this to me was a non-confirming candle, non-breakdown, because we just dipped below in the 60-minute candle close, and we're right on it right now. We could still very much close below there. So the only thing more bearish or bullish would have been a solid close, bring in a lot more shorts, take out the longs. That's the other thing this does, is when you come out and you pierce the bottom of a trading range, besides sucking in short sellers, it also clears out stops on longs. Obviously, this is a very clear level, and so it only makes sense to assume that there's quite a bit of longs, stop loss orders right there, and those are what we call, or I refer to as weak-handed longs. In other words, if you didn't have your stop cleared out here today on that move down, why are you going to sell your long positions now? You had a recovery. So the weak-handed longs have been cleared out, and so that's again the fact that we had that breakdown, this right here. If it sticks, guys, if we go like that, then forget it. It just means that we broke down. We just had a little snap back first, and then we go down, and that's going to be bearish. Okay, there's no other way to spin that. But as of now, as I'm talking, and this can change, that is more bullish than the pullback here yesterday, because you went back above there and cleared out those stops. We know that the long stops have now been cleared out in this area. And yeah, there's going to be some more here. I tend to use wider stops, give myself a little more room. That's why I always say a stop somewhat above or somewhat below. For the same reason, when I'm targeting the top of a trading range, if I'm targeting 267.36, that's not where my sell limit order is. It's going to be a little bit below, because quite often the sellers will step in early. Sometimes you get a full tag of the level, but it's not worth it for me to get that extra, fraction of 1%. All right, so that's it. Let's leave it here, and then again, like the post I got out to you this morning, for the lack of, or for the at the risk of oversimplifying things. This here, that's still the max bounce target if we do break above the range, and we haven't done that yet. But anything here is be long. Enter that, add to longs, and stay long all the way up to, but not below, up to 280. And then again, if we make a solid move through here, if it's going to happen, it's going to happen today. Like I said, there's the fact that we saw just about everything. I saw natural gas tank, crude oil tanks, silver, gold, treasuries. I mentioned that this morning all at once. And those are uncorrelated asset classes. In fact, some of those usually go up when the stock market goes down. And the fact that they all went down tells me it was a heavy institutional selling. It wasn't just retail selling. It was, some hedge funds, some pension funds, some big funds hit the sell button. They didn't like what they saw in the employment report this morning. So that like I said, and I said this yesterday, that the probability of a upside breakout and a move up here might not be very high and isn't. And I've been saying that's not very high. It's just a good risk reward. Every time you can take a shot here at the bottom of the range, you take your shot and you either swing up to the top or, like I said, just trail up stops and try to run up there, because sooner or later this thing's going to break out. That it's going to be today, I think. We're either break to the downside, or if this market can rally. And look, again, we're cracking through that level once again as I'm doing this. So if we break to the downside, that's it. Other than a whipsaw, and I gave you my plan. It's really simple. You know, a whipsaw back to confirm a whipsaw. If you short, you know, let's say I short, let's say we go down. Now at this point, if we take out today's lows, that's probably where you're going to see more and more stops get hit, more and more shorts pile in, and that will probably be the real deal, and it's going to start spark a, you know, another wave down in the market. However, if we go back up, that's where it becomes apparent that you've regained it. In other words, a little breakdown and then a move right here. That's not. It is technically a recovery back into the zone, but that's more than common to see a little back test that goes a little above. That's why at the midpoint of the range, if we break down and move anything back above the midpoint, we're probably going to just keep going. Would be my thoughts. So as of now, I'm gonna leave it there. You take the trades you want to take, pass on the ones you don't. All I can say is it looks ugly right now, but that's when, you know, when there's blood in the streets. And so I'm just going to reiterate, as I did yesterday, this is an objective buying opportunity right here. You're back at the bottom of the zone, 262.50. And again, it might have a lower probability of playing out than a lot of the trades I put out there, but the RR is phenomenal. So here's your stop right here. I'm going to measure it out for you, and then I'll wrap the video up. You buy QQQ or the NASDAQ 100 futures right here at 262.50 or 262.45 right now, with a stop below 261.50. What is that? You know, you're talking a dollar on a 260 point security. So that's well under 0.5%. That's like 1/3%. Super attractive risk reward, because you're risking, let's just say you give yourself a 0.5% stop loss. Okay, if we hold this level and rally up, at minimum we're going to the top of the range. And again, I give you my thoughts. I think we'll break above it. So there's a 2% rally almost to the top of the range. That's a 4-to-1 risk reward ratio right there just for a day trade. But again, I would be more apt to just, if we can defend this, if the bulls defend this level and we get up there again, you know, I thought we might break out yesterday, but you know, I again believe it even stronger today. If we get up there, we're probably just going to take that out and keep going. So the risk reward at that point, if we're going up to at least 280, which is my preferred swing target, then that's almost 7% rally from where we're at, and that's an excellent risk reward. So again, you might not have the best odds. You may get, you know, maybe let's call it 50-50 get stopped. I'd say a little less than 50-50, just like yesterday. I'm still giving it about 60-40 for my bullish case, and I'm maintaining that now because we had that dip down below in a recovery there in QQQ, and then of course SPY and IWM still above the ranges. So that's it, guys. That's where I'm at. Long, but ready to pull the trigger and flip, and I'm also ready to add to those longs if and when we break out above the top of the ranges. So that's Shortsville and Longsville. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.